All right, let's take a look at the Treasury yields this morning. You do see slightly lower yields, but that 20-year is now at 5.1%, just over that. The 10-year at 4.58, the 5-year at 4.13, and the 2-year above 4% as well. This came after a big jump in yields yesterday on a lousy 20-year bond auction. For more insights and volatility on the bond market right now, what it means for investors, we want to bring in Kelsey Berro. She's fixed income portfolio manager at JPMorgan Asset Management. And what does this mean? The 20-year was a lousy auction. I guess the 20-year is the weakest demand for that of all the bonds in the long term, too. But it's a pretty significant move, 24 basis points from a month ago from what they had to pay to get investors to say, OK, we'll take on this risk from the U.S. government. What's happening?
Right. So bond market investors, their focus has really dramatically shifted over the last 2 weeks from trade wars to deficit wars. And the way that this deficit fear is playing out in the bond market is through steeper curves. So actually, I was here a few weeks ago and I looked back at where yields were then. The 2-year yield is actually unchanged, around 4%. That's the anchoring of the Fed and the Fed on hold.
So the Fed can do that, but at the long end, investors have much more say over where those rates are going to stay than central banks do.
Exactly. And so that's where you've seen the movement. Now, I think there's two things going on. One is the deficit. The deficit is a problem, but I think above and beyond that, it's the uncertainty around the path of the deficit. So I find it really challenging listening to these negotiations in the House, but knowing that the bill that the House is going to pass is not necessarily the bill that we're going to get at the end of the day, because it's going to the Senate next.
Meaning you like some of the more fiscally conservative changes that were put in place overnight to make sure that Medicare cuts or Medicaid cuts are made on a sooner basis, that some of the green energy things are phased out. You like those things, but you don't know that it will survive the final.
Right. I mean, that's the uncertainty. I think the other thing that people are not necessarily putting into their analysis is the impact of tariffs on the deficit and on growth. So all of this analysis does nothing to account for what is the impact going to be from tariffs. So we still have the highest effective tariff rate in over 100 years. That does two things. One, it increases the revenue that the government is taking in. That's not going to solve the deficit problem, but that is on net going to help. But it also dulls the growth impact of the fiscal stimulus parts of the bill. So you have the tax cuts on one side from the things that the House is passing in terms of no tax on tips, et cetera. But on the other side, you have tax hikes from tariffs. So I actually think that the net fiscal impulse from this is a little bit less stimulative than people actually appreciate once you factor in tariffs.
And that's what, in a perverse way, that's what the case they're making in this editorial, that some of these concerns are now that the growth aspects won't be as effective, which won't let consumers feel better, which won't allow us to have the revenue from taxes to service our debt, so that we're going to ask for more when we sell, which is a perverse way. You would think that something that dampens growth will cause yields to fall, not go up. But if the growth isn't there from all these growth provisions,
but we keep spending,
and we keep spending, then we're unable to service, then 20 years are going to get harder and harder to sell.
Right. So this is all very circular, essentially, is what you're saying.
Like, what?
But I get back to the key point being uncertainty. We still are in a period of very high uncertainty, whether it be we still don't know what the end point for tariffs is going to be, and we still don't know what the end point for the fiscal trajectory is going to be, what the ultimate budget bill is going to be. And as a result, the way that this is, again, manifesting itself in the bond market most clearly is through steeper yield curves, more term premium, and that's why you saw the lack of support for the 20-year auction yesterday.
What's the next test? I mean, again, the 20-year is the weakest demand out there for the 20-year of any of them. What's the next test? Is there a 10-year, a 30-year you watch? We were even watching the 3 and 6 months on Monday for the Treasury auctions that were here.
I'm not particularly worried about the Treasury auctions more broadly. I think what the market is missing right now is any focus on the fundamental data. So one of the reasons why I think that the Moody's downgrade on Friday and this debate in the House is getting so much attention is there is a void of any other data out there for the market to focus on. So, no jobs data yet. We do have initial claims this morning. No inflation data. And in that void of data, you can get narratives that persist and momentum that pushes trades maybe further than they even are meant to go.
So do you think that this is a position where you would tell people to buy these treasuries or buy other credit out the spread from that as a result? Because you don't think that this is going to be a continued force of pressure on the treasury market?
Long-term yields are, from a valuations perspective, looking very attractive here. And when we talk to long-term investors, when they see the treasury yield, the 30-year treasury yield at 5% or above, they see that as an attractive value. But what we need to recognize is that if you're going to jump in and take advantage of that value, which we do think is there, there's going to be some volatility ahead that you need to be comfortable with.
But you don't think it's going to be like a moment like the UK had, where the markets just say, no, we're not going to go along with all these taxes. You don't expect it to get out of hand and actually cause a mutiny on what happens with this bill.
Well, I think you are seeing signs of that already, of that market discomfort. And
discomfort's different than a full-on trauma.
Right. But what you saw yesterday was a combination of three things, which was challenging, which was a weaker dollar, higher yields, and lower equity prices. We saw that for a brief period of time in April. It subsided. That's what we saw again yesterday. Yeah. That's the type of toxic combination, that is going to bring more attention to this problem.
The yips, right?
The yips.
Except for Bitcoin.